Welcome to this chapter on quantitative easing, or QE. Here in 2014, the developed world is currently in the middle of the largest monetary experiment in all of history, one that spans the entire globe. This is very important because when you strip away a lot of economic gobbledygook, money is really a social contract. We agree that it has value, but otherwise, it's backed by nothing more substantial than that, our mutual agreement. Given this context, we should view money printing as really more of a social experiment than a sophisticated monetary practice. And so we're going to study it here as such because when a nation's money system breaks down, society as a whole is impacted. Commerce is heavily disrupted, shelves are cleared, careers are ruined, and the future is badly diminished. So what exactly is quantitative easing, or QE? Well, it's money printing. Simple as that. However, today we don't actually print all that much physical cash. So when I say money being printed, don't think of big stacks of $100 bills. Think instead of digital ones and zeros, mainly a lot of zeros, showing up on electronic ledgers. We discussed QE briefly in the chapter on the Fed, but here we'll go into it in slightly more detail. Again, the way the Fed creates money is simply by creating an accounting entry that says the money exists. Imagine if one day you woke up, checked your bank account, and found $1 billion in it. Looking into it, you discovered the Fed had deposited that money there last night. This money would be very real to you and would completely change your financial circumstances. You could spend it just the same as if you had earned it over 66,313 years, working at the current minimum wage of $7.25 per hour and saving every dime. But where did the Fed get that $1 billion? What did it do to earn that much money? This quote tells the tale. And let me highlight that last line, because that's the important one here. When the Federal Reserve writes a check, it is creating money. Now, in our example, the Fed simply created money when it sent it to you. Tap, 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 a few keys were clicked on a keyboard, and voila, your $1 billion was created and deposited in your account. At the end of 2013, this process was being used to the tune of $85 billion per month. Only that money was not going into your account, not unless you were a very large financial institution. The Fed creates that money when it buys either treasury bonds or mortgage-backed securities, which is what MBS stands for. And the mechanism is really easy to explain. Say the Fed wants to buy $40 billion of treasury bonds. Well, first it will announce to the market, which actually means the big banks who play in this game, that it wants to buy $40 billion of treasury bonds and the price range it's willing to pay for them. A variety of banks will then offer up the specific bonds at specific prices, and the Fed chooses which among them to actually buy and then buys them. These bonds are now assets on the Fed's books, so if we were to take a look at the Fed balance sheet, we should see it growing by leaps and bounds over the last few years. Indeed, that's exactly what we see. The Fed's balance sheet is now nearly $4 trillion in size, and every single one of the dollars represented by that $4 trillion number was literally printed, or mouse-clicked, into existence out of thin air. Now, to really make the point that these are extraordinary and unusual times, I shall point out that the Fed's balance sheet was only some $880 billion before the economic crisis struck in 2008. That is, to grease every economic transaction throughout the nation's entire history, up until 2008, required the cumulative injection of $880 billion of circulating base money that the banks could use to lend out via fractional reserve banking. But since 2008, an additional $3 trillion has been created by the Federal Reserve and injected into the system. So where did all that newly created money go? What did it do? Well, we should be able to detect it if we look at a chart of circulating money in our system known as base money. And yep, that's exactly what we see. This additional $3 trillion has found its way into various corners and crevices of the financial universe, but the majority of it, around $2.3 trillion, is parked right back at the Fed in the form of something called excess reserves. Now, recall, banks keep some money in reserve when they make a loan out of deposits. And if they keep more than is required, that money is called an excess reserve. So this chart tells us that the Fed has been pumping money into the financial system, but the majority of that money has not been made available to Main Street in the form of new loans. Instead, it has been round-tripped and idly parked back at the Fed, where it earns 0.25% interest. But this still leaves us with some $700 to $800 billion, which has not been parked in the form of excess reserves, which is out there bidding up stocks and bonds and real estate, mainly due to large institutions buying up vast quantities of all three asset classes using money the Fed printed out of thin air. This chart showing the relationship between the S&P 500 and Fed printing tells the tale. It's a safe prediction to make that the U.S. stock market will fall and fall a lot if the Fed were to suddenly stop printing up money. The stock market is now hooked on this artificial stimulus. So, how long can this money printing continue? At some point it needs to stop, right? I mean, we'll destroy the value of the dollar if we print too many of them, right? The answer to this is yes, but it's a lot easier to say than to do. A huge but poorly understood concern is that this freshly printed money, once created and released into the financial universe, is going to be very, very difficult to retrieve, should that be necessary. You see, quantitative easing, it works really well when the money is going out the Fed's front door, but it's not going to work very well in reverse. In fact, it may be impossible without crashing the stock and bond markets, creating all sorts of difficulties for both the Fed and our leaders in Washington, D.C. And here's why. When the Fed is out there buying a huge proportion of something, say, Treasury bonds, the price of that asset class is driven up in the marketplace by the demand being artificially created or printed out of thin air by the Fed. That's just economics 101. Because the Fed pre-announces its asset purchases, the folks it buys these assets from have a huge advantage. And here's why. When the Fed announces its plans to buy a bunch of Treasury bonds, the banks rush out and buy them first. This is called front-running. Then the banks turn around and sell these very same Treasury bonds to the Fed, but at a higher price than they bought them for, allowing them to pocket fat profits. Pretty sweet deal, huh? Everyone is happy playing this game. The U.S. government enjoys a strong market for its debt, plus gets ultra-low interest rates as part of the deal. The banks make big money with no risk, and the Fed gets a lot of freshly printed money out into the system, further driving down interest rates, which boosts the bond market, the stock market, and housing prices. Now that's a win-win-win situation right there. Well, as long as you're one of the ones receiving the money, I suppose. In this scenario, everyone loves the Fed and its magic checkbook, which makes all these popular results possible. Well, at least to everyone in power that can skim easy profits from the system. But now let's try running that process in reverse. What happens when the Fed decides it's time to stop flooding the world with free money and instead attempts to reduce the money supply, when it tries to reverse the flow of money from out the doors to back in its doors? Where the Fed was buying Treasury bonds from the banks at a profit to the banks, when the Fed turns around to sell these same assets back to those banks, the reverse will, by definition, be true, meaning the banks will be buying Treasury bonds that are falling in price, not rising. The Fed will be demanding money from the banks and in return will be giving them bonds that it is flooding the market with. Prices in a flooded market only head one direction, and that's downwards. And at the same time, the U.S. government will still be selling plenty of new bonds into the market. Only now, the Fed won't be there buying them. What does this mean? It means that the new bonds from the government, plus the ones being sold by the Fed, will be competing for a dwindling supply of money. And mathematically, that also means that interest rates will be rising. And as interest rates go up, the bond markets will suffer losses, as will stocks and home prices. That is, everything the Fed has worked so hard to engineer since the 2008 crisis unfolded will be undone. And likely within a very short time period, perhaps just a few months. If you've been wondering why the Fed spent most of 2013 hemming and hawing about whether or not to decrease or taper its ongoing $85 billion in monthly asset purchases, this is the main reason. It fears undoing all the years of hard work it spent getting the stock and bond and housing markets to inflate. But if the Fed cannot easily undo its quantitative easing efforts, then what are the risks we all face? Well, here's where history is really quite clear. You can get away with printing for a while, but when it catches up with you, it does so with a vengeance. The reason is not terribly hard to understand. You cannot print true prosperity. Real wealth does not come from printed money. Real wealth only comes from real people performing actions that create real value. If it were possible to print up prosperity, every central bank should simply cook up enough new money to hand out to its citizens and eliminate poverty forever. But, of course, that cannot work. Money is not real wealth. It's merely a claim on wealth. You can print up as many new claims on wealth as you want, but the amount of real stuff, if it remains the same, then it's going to shrink in relation to all that printed money. That's called inflation. Quantitative easing and the other central bank shenanigans of the past several years are not ordinary. They aren't normal, and they haven't been tried before. They signal a huge and abnormal departure from everything we know about what works and what doesn't work economically. It is an extraordinary experiment. You and I, we need more to our wealth strategies besides complacency and hope. Perhaps this time is different, but if not, and it almost never is, then we should all be crystal clear on the risks. At the exponential pace at which the Fed is increasing the money supply, and knowing the huge challenges the Fed and most of the other world central banks face in trying to stop or even slow down their money printing, the potential for a disruptive global inflationary period is very real. Which brings us to the next chapter on inflation. Thank you for listening.